All right, good morning. It's the 16th, and I was just going back over some charts. I wanted to show you a highlight from the 4th that was really amazing. Um, First of all, this is a video. This is a highlight HLCL from January 4, 2016. And what you want to note here is that first of all, the previous lower day is $3.10 from the high. That's a big distance from the higher day, from previous day. So the previous day, um, the price moved $3.10 down. All right. So you really kind of, when you see that extreme move, you want to start looking for a reversal. You really kind of want to start looking for a reversal at this point. And that's why I'm putting here, this is previous close, this is previous lower day. You're really looking for something that's going to happen around the previous lower day because of that reason, that big distance from the high. So what we're seeing here is at, oh, I don't know, somewhere around 9:30. I mean, there was a couple trades in here, but I'm really highlighting HL as a highlight. What happened on, after the equity open at 9. So equity open retested the low, right? So here you have a retest of the low. And we broke the Bollinger Band. Here we broke both Bollinger Bands, the -3 standard and the -2 standard deviation Bollinger Band. We broke that. We had an oversold signal on the CCI. All right, so this is really your criteria for entry. You're very oversold. You add previous low, which is very likely to act as resistance. Your CCI indicators telling you you're oversold. You're probably -200 or so right here. And now what you need is an entry candle signal. And what are we using for that? Well, what we're using is a break above the 5-period moving average. All right. So let me just blow this up a little bit. All right, this is your 5-period moving average, the blue line. This is your breakout candle. You see, this candle closes, this is the close up here, above the 5-period moving average. After this signal, after this oversold signal, this is your entry candle. So on entering there, you want to put your stop loss below the Bollinger Band, like so, right? Or if you think that's a little too risky for you, you can come down to the -3 standard deviation Bollinger Band and put it down there. But you could mainly put it right here at -2 standard deviation Bollinger Band. And as you can see, once it did that, it retested this zone here. Retested that, but you didn't get taken out because Bollinger Band saved you. All right. So you would have been okay. You would have rode this wave up. See, we're trying to go from oversold to overbought. Would have rode this wave up until you got to let's put up a, so you're overbought in here somewhere. This is your entry. You're overbought in here. This is your overbought signal. And so you could have got out here at this candle. and you would have had a $140 profit from entry to exit. And as you can see, that the reason why this is the exit is because this candle closed below the 5-period moving average, and it's also bouncing off a previous close. So it could have continued down. If you were playing real conservative, you just would have exited right here. All right, the second exit. All right, so that's exit number one. You would have had a $140 profit there. If you manage to stay in this trade and say you either just went to break even or you were following along the 20 period, okay, you would have been in the second arm of this move. I'm going to show you what I mean by that in a minute. You would have been in the second arm of this move, and you would have exited here at this candle. This guy here. Okay, see how it closes below the 5-period moving average. You would have been in and captured that whole move for a $610 profit in under 2 hours. And you would have put your stop, your stop. You might have gotten a little more aggressive around here with your stop. All right, backing up a little bit, I want to talk to you a little bit about what I meant by one second arm move, a 2-arm move. See, a lot of times when the market makes a move, like say from this extreme end, it kind of bounced off this 20-period moving average, retrace, and a second move. So let's look at that. All right, so what you're seeing here is a move from this oversold area, bounced off of the 20-period moving average, back to this area, back to this zone. CCI went to halfway level, back to the 0 line. And then it took off, second move, back to previous close, which is overbought. All right, and that's kind of move number one, we'll say. Move number one. This is really move number one here. When you bounced off a previous close, see it came back to the 20-period moving average, kind of retested this 0 line on the CCI. And now move number two, bam, broke through previous close. Now you're back at pivot point. You see it, pivot point, PP acted as resistance, pulled back to the 20 MA on the 0 line. And then there might have been another move in here. We'll see. Let's see. Yeah, there was another move. Let's see. That's what I'm saying. Like if you were in this arm, if you were in this arm already, you could have done one or two things. You could have gotten out on this candle at the pullback to 0, or if you want to stay in the move, then you put your stop below the 20-period moving average, hoping for a second move. Bam, back to this overbought area at pivot point, and you knew that once it hit that pivot point, it's going to pull back again. And if you wanted to stay in even longer, you would have your stop here. You would not exit. You would not exit on. You would not exit on this candle here. You see, you would not exit on this candle if you wanted to try to get another arm or try to get another move. You would have your stop here. And hopefully the market would have taken you up. So it all depends on your intuition about the market or what you think it's going to do. It also depends on how conservative you want to be. If you were in this move and you were happy with the 140 profit, you pull out. If you're not happy or you think it's going to make another move, you're seeing that the bars are moving very aggressively. You put your stop here at the 20 period moving average, and you wait for that second. You wait for that second impulse move to pivot point. So yeah, I think that's what we'll wrap it up today. Talk to you later.